and joining us tonight. I was very fortunate in bumping into Jordan at the 350 table at the Roundhouse in the on the environment, what is it, Environment Day or Water Day, one of those days, 2 or 3 weeks ago. And we had a really great conversation, and a little flag came up in my brain, and this would make a great speaker series. There is legislation on the Green Bank in front of the legislature this year, and there are other bills that are related to this. So I think it should be very pertinent going forward to what we're all dealing with in the next couple of weeks of the legislature. Jordan, why don't you give us a little backstory on how you ended up here and what you're up to?
Sure. Thanks, Jim, and thanks everyone for having me and for joining tonight. As Jim mentioned, my name is Jordan Haedtler. I arrived in the beautiful state of New Mexico in late December, and I've been doing some work in the legislature ever since. But I come here from DC, where I worked in Congress the last several years, the last 3 of which were for Chairwoman Maxine Waters on the House Financial Services Committee. And the portfolio that I covered.
Clara from the Vineyard. So this Zoom is starting in earnest. Can I just give you my
Tom, I think you're
Mr. Singer.
I'll text him my
Would you
email
mute,
address
please?
and come through sometime, okay?
Is it possible to mute Tom?
Okay.
Yeah, let's see if
Okay.
I can do that.
Okay. So the portfolio that I covered on the committee was all things Federal Reserve, so both monetary policy and financial regulation and stability, insurance, and then especially after the Biden administration took over, the development of a climate risk supervision framework by federal financial regulators and the banking agencies. And I have a background before working in Congress, working in state politics. I worked in state politics in Pennsylvania for a while. I worked for a couple of years in the California State Assembly. So what I've begun doing since last summer is working with a coalition of organizations and primarily with the Sunrise Project to try to apply that federal climate risk supervision framework to the state legislative and regulatory context. And I'm sure that probably doesn't make a whole lot of sense. So that's basically what I'm going to talk about today. Can you see my screen here?
Yep, looks good.
Great. All right, so I'll begin by sort of describing how climate change is increasingly being understood, not just as an environmental crisis, but as a threat to the safety and soundness over the overall US financial system. And it's increasingly being conceived of really as an economic policy as much as an environmental challenge. And it's intersecting with the financial system and with household finances and constituents' pocketbooks more and more. A climate financial 101 is that in financial regulation, the risks that climate change poses are generally conceived of in 2 broad buckets. One is physical risks, and those are losses that occur from climate disasters, floods, wildfires, storms, droughts, etc. And then transition risks are the other major major risk, climate-related financial risk. And those are the losses associated with a policy framework that enables us to transition to the kind of future that we need to achieve a 1.5 C future. And so all of the assets that are and loans that are currently dedicated toward the fossil fuel sector are based on an expectation of future profits that can't possibly come to pass if we hope to achieve our climate targets. And so this creates a problem known as stranded assets. And a report last year found the value of stranded assets to be over $1 trillion. In other words, fossil fuel companies are betting on a future that can't possibly come to pass. And I like to make this point that, there's a notion that transition risks will only manifest themselves if we aggressively start shifting policy toward achieving our climate targets. But that's actually not the only risk that's not the only sort of form that transition risk takes. There can also be a dramatic shift in consumer preferences as climate disasters instill more and more damage on individuals and households. There could be an unforeseen technological change that diminishes the value of fossil fuels even faster than expected. And there can even be sort of, on a more dismal note, civilizational chaos and collapse. All of these things are transition risks. So whether or not we align our financing and align our policy aggressively with the demands of a 1.5C future, the transition risks associated with climate change are quite pronounced. These are the sort of terminologies that banking regulators tend to use at the federal level, but it's important to note that these two risks also have implications for state budgets. So the image on the left is from a Pew report that came out in November that shows that states like New Mexico that are facing growing wildfire problems are facing major problems with balancing their state budget because of all the costs associated with wildfires. And then on the right,
Jordan, if I could interrupt, I think your slides are not advancing in the view that we're seeing.
There we go.
There we go.
Okay. And then on the right side, you see this is from a report that the Center on Budget and Policy Priorities put out in early 2021. And it observed that although the $1 trillion plus budget shortfalls that had been projected early on in the pandemic for many state and local governments, thankfully did not come to pass, in large part because of the federal assistance that was provided through the American Rescue Plan and a faster than expected economic recovery. There were quite a few states that still saw shortfalls in early 2021, and those states were disproportionately states like New Mexico that have a high degree of dependence on fossil fuel revenue. So since President Biden took office, in May of 2021, he issued an executive order that directed Janet Yellen in her capacity as Treasury Secretary and therefore chair of the Financial Stability Oversight Council, or FSOC, which is a Dodd-Frank created body of federal financial regulators to study and examine climate as a financial risk. They put out a report in October of 2021 that identified climate as an emerging and increasing threat to America's financial system, and it directed all of the member agencies of FSOC to begin taking action to address climate as a financial risk. The SEC put out last March a climate risk disclosure rule that largely governs what I think the rest of the federal government is going to do, that requires public companies to manage and disclose their climate risk. That rule is not yet finalized, although it's expected to be soon. The Department of Labor in December finalized a rule that allows the private pension fund managers to consider climate risk as a factor in pension fund management. And that rule is actually the subject of a pending attempt by congressional Republicans in partnership with our friend Senator Manchin to attempt to repeal that rule and potentially force President Biden to issue his first veto. So that's one of the main things going on in Congress right now. But their main point is there have been a whole host of federal agency actions and regulatory actions that sprung from this October 2021 FSOC report. And as you just heard, it has provoked a major backlash. But now with divided government in Washington and the Inflation Reduction Act representing a historic sort of climate investment, states are proving to be the critical battlegrounds. And in large part that I think in major part, the extent to which the IRA and the bipartisan infrastructure law from the year before and the CHIPS and Science Act and the other major pieces of legislation that were approved in the last Congress, they have been hailed as transformative, both for climate and industrial policy. And I think they have the potential to be, but I think that depends and hinges largely on what states like New Mexico do to implement their many specific provisions. I'll get into that in a moment, but I did want to mention that something that has unfortunately consumed far more of my time in my new job than I wish is that the SEC rule in particular, and also the Department of Labor rule and other attempts by the Biden administration to begin to regulate climate as a financial risk has provoked a very strong and powerful backlash with huge support from well-known figures on the right, like Leonard Leo, the architect of the Dobbs decision, the American Legislative Exchange Council, the Heritage Foundation, the State Financial Officers Foundation, which is a set of Republican state treasurers, and of course, the fossil fuel industry is funding this to a very great extent. And they have been attempting to frame ESG, environmental, social, and governance investing, or socially responsible investing, as woke capitalism. And this effort really began in 2021, 2022. The State Financial Officers Foundation was involved in preventing the confirmations of Saule Omarova, who was nominated to be comptroller of the currency, and of Sarah Bloom Raskin, who was nominated to be basically the top regulator at the Federal Reserve. And they unfortunately succeeded in their attempts to prevent the confirmations of those two key bank regulators. And after achieving that success, they realized the potency of their attacks on climate financial regulation and have explicitly spoken about this as the next critical race theory. And the Nebraska state treasurer was quoted a few months ago as saying that ESG was going to be the critical race theory of 2023 and 2024. And they have begun to pass model laws promoted by ALEC that prohibit state governments from doing any business with financial institutions that are supposedly boycotting fossil fuels. They have also have another variation of the bill that seeks to exclude state treasurers or other public pension fund managers from taking any ESG or climate risk considerations into account as they steer the state's investment portfolio. 7 states have passed variations of these laws over the last 2 years. And although this graphic I'm showing is sort of bad enough as it is, it's only a week old and it's already out of date. There have been actually, it says 95 in 25 states. There have now been 113 bills introduced in 29 states just since January 1st. And one of the major things that I've been focused on, in addition to opposing these bills wherever they've been introduced, is seizing on an insight that we've gotten in a lot of the message testing and research that we've done into this issue, that sort of the best defense is a good offense, and that there are proactive things that Dem trifecta states should be doing to protect their constituents from the financial implications of climate risk. But as you'll see from this graphic, there really has been a lag in sort of Dem trifecta states taking action. Maryland passed a bill called HB 740 last year that requires the comptroller, the chief financial officer in Maryland, to conduct a climate risk assessment of Maryland's investment portfolio. And that's pretty much it. There's a bill in Colorado that moved through the Senate Finance Committee that does a sort of similar thing. I'll talk more about that in a moment, but that's kind of the only game in town that's been moving this legislative session. And so Democratic states are sort of really falling behind as the culture war ramps up and attacks on ESG have been proliferating. And so I'll say a little bit more about why we think that there need to be more proactive climate financial policies advanced in order to help stop and undermine these Republican attacks. So one thing is this graphic shows some polling data that basically asked voters to say what they know about ESG. And what they know about ESG is basically nothing. It is, in many ways, you can understand why Republicans have sort of conceived of this as their next critical race theory. It has a lot of similarities to critical race theory. It is a not well understood academic term that if you carefully explain to people what it is, most people think it's basically a good thing. But of course, we don't live in a world where you get to carefully explain concepts in academic acronyms to people. And so it is an empty canvas that Republicans have been able to paint a lot of misinformation about. And so defending ESG on its own merits, as some organizations seem inclined to do, is not really a working tactic from what we've been able to tell. But what does work is explaining to people that you're investing their pension funds in a very promising clean energy transition and all of the economic benefits that entails. And I'm going to talk more about insurance in a moment, but voters overwhelmingly think that what's been happening in the housing and insurance market as the climate crisis escalates is unjust. The denials, the underpayments, the cancellations, the withdrawals from certain markets are perceived as incredibly unjust, especially because insurance is the one benefit that everybody pays into that they hope that they never have to see the tangible benefits from, and people pay premiums on a monthly or annual basis and expect that if the worst happens, that they will have their home covered. And in some climate vulnerable communities, as I'll discuss, that's not actually happening. And voters are overwhelmingly outraged about that. And so policies that shield the public from the fallout, especially from a financial standpoint, are very popular. I've been talking for a while, and so I'm going to pause and take questions at about mostly the kind of like, well, sort of the financial framework that I laid out, and I suppose the red state defense, if you want to call it that, that I just explained.
Jordan, maybe you could stop sharing your screen so we can see the audience and if they want to raise their hands.
Yeah, Jordan, I'm gonna jump in real quickly. This is Jim with 350. Those charts and maps are fascinating. One of the things that occurred to me by looking at your national map of what states are dealing one way or the other with this impending crisis is that at least to date, it's a large number of states, but a small amount of the total economy of the country. So that's just one question. It seems like this funny parallel to the COVID pandemic, where the Republicans refused to deal with it. And if you look at the morbidity statistics, those people in those states were a lot less healthy. So what collision are we going towards here?
Try it again, Jordan.
Okay, thanks. It was not allowing me to unmute myself for a moment there. Well, that's a good point. I think it's important to note that with the anti-ESG attacks, although it's generally true that the investment portfolios of Dem trifecta states vastly outweigh the investment portfolios of Republican-led states. Two of the early actors in this space have actually been Texas and Florida. And so while we sort of can anticipate that maybe private asset managers like BlackRock might say, oh, well, who cares if a bunch of sort of dwindling fossil fuel economies engage in some demagoguery against us. That's not really what we've been seeing, because there has been, in fact, a chilling effect, and you have seen major financial institutions like BlackRock withdraw from some of their net zero commitments. Vanguard pulled out of the Global Alliance for Net Zero that was formed after the Paris agreements a few weeks ago, for instance, and it was entirely about this coordinated attack and backlash. And so I think the key thing to emphasize, though, is that this is having a very costly effect on the debt servicing costs of the states and municipalities where this law is being adopted. I'm going to put a few links in the chat now that show that there have been studies that showed that the Texas law, for instance, because of the effect that it had on competition in the municipal bond market, cost the Texas public an estimated $532 million in just the first 8 months that the law was in place. we put out a similar study that projected that methodology to 6 additional states. Indiana, the bill there started to move, and then it hit a trap, which was that the nonpartisan fiscal analyst estimated that it would cost nearly $7 billion in lower returns to their pensions over the next decade. So, Jim, you are totally right about the irrational nature of this. And what we'd like to do is make and put that counter pressure on the asset managers and take advantage of the fact that generally speaking, the blue states investment portfolios outweigh the red states. Tom, looks like you have your hand up.
Yeah, I'm still thinking about what you were just saying because it's so cool. It's too bad that the oil and gas industry had their last 2 years performance and aren't stuck with the prior 5 or 7 years. It made life harder. Just a quick question about making a distinction between pension funds and permanent funds in ESG and sort of the world of development finance. And I'm wondering if you've encountered sort of climate analytic requirements on outfits like the World Bank or the regional development banks trickling down to state development finance activities, and if they're models for how the progressive economic development entities are looking at climate. Is there any work been done on that?
Trying to make sure I understand your question. Is your question, how does the international landscape influence the national and state landscape? Or
no, like the Maryland bill, I'm wondering if there have been requirements on economic development funders to look at the climate impacts of their investing. Unlike market investing of pension funds and permanent funds, this is sort of project specific or more target investing. And are there climate screens models out there for those kinds of entities? Because New Mexico is going hog wild on developing development funds, and it would be nice to handcuff them.
Yeah, so I'm not super expert, particularly on the international development agencies. I do understand that there have been attempts to constrain particularly coal investments that are made by the World Bank and other international financial institutions. My understanding is that most of the work that has been done toward that end has been in the form of voluntary pledges. And you may have been following a lot of figures on the left and in the climate community are not especially enthused about the person that President Biden just put forward as the new World Bank president. But there is a lot happening in financial markets, particularly in response to, yes, what's happening in the US, but the European Central Bank and Bank of England have been moving faster and further on a lot of this climate financial regulation. And so there's a lot of activity that has fostered with respect to social development bonds. And there's a really good paper that I'll also put in the chat that talks about sort of the dichotomy or the friction that's often posed between divestment, fossil fuel divestment, and the desire by some to use shareholder voice. And it looks at social development bonds as a potential mechanism to sort of bridge that divide. And I'll just share the paper rather than trying to explain it right now.
Thank you.
Jordan, we have one question in the chat. Are you aware in New Mexico if we have any ALEC template legislation that, like you referenced, had been promoted in other states?
So thankfully, as far as I know, the answer is no at the moment, but I will certainly alert everyone if that happens.
Great.
I think if I could answer, I think the HB 96 attempt to define combined cycle natural gas as a renewable fuel was, if not an ALEC bill, it's a bill which has been introduced in a similar nature in many other states. It's part of the push for the natural gas industry to see if they can get their hooks into the renewable energy transition train. And it was tabled, fortunately, but that doesn't mean they won't keep trying.
That's right. In fact, like one of the bills or one of the areas we were watching was one of the states we're watching was Ohio, because they have such a heavily Republican legislature that we didn't think there was much of a chance that we'd be able to stop the anti-ESG ALEC bill that was inevitably introduced there. And then in early January, there was like sort of a surprise election of a supposedly more moderate Republican speaker. And so for like all of like 24 or 48 hours, we were like, oh, maybe we have a chance. And then the very first action by that speaker was to pass that ALEC bill to try to define natural gas as like a clean, sustainable fuel. So it sort of made us a little bit less hopeful. But yeah, that is an ALEC bill that's been introduced a lot of places too.
All right, well, I think we're ready for you to give us more.
Okay, just right before I do, I want to make sure that I close the loop on the things that I was putting in the chat. Or well, actually, I'll come back to that. Okay.
Is that Luke Gonzalez has raised his hand?
Yeah, I just had a quick question. I was wondering if you could just go back to a little bit about the who specific or what was happening in Congress where they were attacking the I forgot what organization it was called. Like just what specific things were they like doing which were shutting down the things that we were trying to promote for climate change and all that?
Yeah, so two of the key regulators that that President Biden put forward to sort of implement the climate financial regulation proposals that have been put forward were Saule Omarova, who is a Cornell law professor who I've worked with quite closely on infrastructure bank proposals, which is the next thing I'm going to talk about. And her nomination was defeated in December of 2021, in large part because they began previewing some of these woke capitalism attacks and basically sort of totally misconstrued a lot of her research and work around climate financial regulation specifically. The other person was Sarah Bloom Raskin, who was nominated by Biden to be the vice chair for supervision at the Federal Reserve. And she's an incredibly accomplished regulator who had been the deputy Treasury Secretary and had also served on the Federal Reserve Board of Governors under President Obama. And she even had support from the community bankers and from banking associations. But again, it was the fossil fuel industry that seized on some of her statements about climate as a financial risk and prevailed upon Senator Manchin to oppose her nomination and killed her nomination. And then the other thing that's happening right now is that the DOL, the Department of Labor, finalized a rule around ESG considerations in pension fund management. and allowing for pension managers to consider climate risk and how climate would affect the value of investments. And it's not prescriptive at all, but it's being portrayed as though it is part of this whole woke capitalism narrative. And Senator Manchin has signed on to the Congressional Review Act resolution to rescind that Department of Labor rule. And the House Republican majority is expected to vote this week on that Congressional Review Act rule. It's unclear if it's going to have the votes in the Senate. There's a lot of concern that Senator Tester from Montana and Senator Sinema from Arizona may join Manchin, in which case the resolution would have the votes to pass, and it probably wouldn't rescind the rule because President Biden would veto the bill, but it would still be very embarrassing and damaging for any other future prospects, because in all reality, this is a very modest rule. And so if they're able to rescind this, what else are they going to be able to do? To talk about more hopeful things, one of the key ways that I think states are positioned to implement a positive climate financial agenda and integrate their state's economy and their state budget and investment portfolio with the benefits of an economic transition is by taking advantage of $27 billion greenhouse gas reduction fund that was approved through the Inflation Reduction Act. As I mentioned, I worked in Congress with Sally Omarova on her proposal for a national investment authority. And it was that work that led me to be following a different proposal to create and fund a clean energy accelerator, which ultimately made its way into the Inflation Reduction Act. And in the fall, after the IRA had been signed, I worked with Boulder County, Colorado, to put out a paper recommending proposals and policy recommendations for how state and local governments should design what are being termed as green banks to attract this money. And so I'll put the link to that memo in the chat, but I'm very glad to say that New Mexico has a bill to create a climate investment center, which is meant to be the vehicle for attracting this substantial federal investment, and will steer those investments toward a range of consumer-facing climate clean energy projects. And the bill passed with a bipartisan vote a couple weeks ago on the same day that I met Jim at the Roundhouse out of the Senate Conservation Committee. And so I think it's scheduled next to be in the Senate Finance Committee, which is chaired by Senator George Munoz. And it's something that I know 350 has signed on, I believe, in support of. It's an enormous opportunity, I think, to attract substantial federal funding to New Mexico. And there's people on this call who have been working very actively toward that, and happy to talk more about that. But I'll just move on away from sort of IRA implementation ideas and talk about the one proposal that is most directly in conversation with these anti-ESG attacks. And that is legislation similar to the bill that was enacted in Maryland last year. And the idea here is to require state pension fund managers to conduct a climate risk analysis of their state investment funds, and to embed those climate risk principles into proxy voting guidelines so that the state institutional investors are aligning their votes every shareholder season with the imperatives of responsible climate risk management and a 1.5C future. And I want to pause here because although, as we saw with the graphic earlier, this hasn't been legislation like this hasn't been introduced in a very large number of states quite yet. The Colorado 350 has been promoting a bill, SB 2316, which is a very comprehensive climate bill. It touches on a lot of different subjects, including insurance, some provisions related to the division of oil and gas resources, but sections 2 and 3 of the bill until last week were related to pension fund management and directing Colorado's public pension fund, PARA, to not only engage in this kind of climate risk assessment, but to align their investments with their proxy voting practices with the climate targets that Colorado strengthened through a law that was signed in 2019. And there was a Senate Finance hearing that I was in Denver for last week, that where the bill passed, it advanced, it's considered likely to become law. 350 Colorado is still prioritizing it as their #1 bill this session, and they're excited about it, but it was unfortunately weakened, and this was largely because PARA, the state pension fund, and I think a number of labor organizations, sort of that comprise PARA and have many PARA representatives, made the assertion that this was using the pension funds to sort of direct social objectives, and that this would diminish returns. And there are ways to draft the language so that you are not giving the impression that you are subordinating returns or labor considerations to the climate targets. And those potential tweaks, I think, probably could have preserved that section that was struck from the bill. And so we haven't really seen a successful example of this, this piece around climate risk assessments and pension funds quite yet. And I think that is because we haven't done a good enough job. What I mean by we is sort of the climate movement, of making sure that labor organizations and pension fund representatives are consulted from the beginning when drafting this sort of approach. And so if this type of bill, if you're interested in developing this type of bill in New Mexico, which I think would be a really good idea, I'd love to work with you all to make sure that labor and pension funds and the state treasurer's office, et cetera, are engaged from the beginning, because I think there's a way to do it that will be more successful. Does anyone have any questions on that point before I move on to the insurance section, which is probably the most meatiest part of my presentation?
Yeah, I have a question.
Yeah.
So, Jordan, is the methodology for conducting a climate risk assessment well enough defined so that I mean, is it documented well that you could just say, go do it, and here's the instructions, and you give that to the financial officers and they know how to get the job done?
Yeah, I mean, I think that you can, I mean, the Colorado bill, a similar bill that has been introduced in Washington, the bill that passed in Maryland, they're a little bit more prescriptive than that. But without going into all the details, the principles for climate risk management and climate risk data have been enunciated and reinforced through, for instance, like the SEC disclosure rule. But prior to that, there was an international body of regulators called the Task Force for Climate-Related Disclosures, and they've put forward a very widely recognized sort of set of climate risk principles that I think any financial regulator could act on.
Okay, thanks. Mark me down to as interested in developing such legislation in New Mexico.
Great. Okay. Let's talk
And
about
I'm gonna sign up Tom Singer too.
it. Okay. Okay. Well, if there aren't any other questions on that, it sounds like you and I you and I and Tom will work together on that. But I'll move into insurance because insurance is really one of the major channels through which climate risk is being transmitted to the financial system. You know, it may seem obvious in the sense that the physical damages from growing climate disasters are even threatening insolvency for some small and mid-sized insurance companies. But particularly the larger insurance companies are much more interconnected with the banking system and with hedge funds and asset managers and so forth than they were 10, 15, 20 years ago. And there's some financial stability experts who are now serving in the Biden administration who wrote a really good report about this a few years ago. I'll put that in the chat too. And one of the examples that they highlighted was that there was hurricane, I think it was Hurricane Andrew in 1992, did about $15 billion worth of damage to Florida and caused the failure and collapse of a few small insurance companies in Florida. And they sort of made the point that if a similar event happened today, some of the same insurance companies would have been far more exposed and caused far more damage to the broader financial system. And of course, against that backdrop of an increasingly interconnected financial system, you also have rapidly accelerating climate disasters. So the FSOC report that I mentioned earlier from 2021 also directed the Federal Insurance Office, which was another Dodd-Frank created agency that sits within the Treasury Department to look at what they could do about climate risk. And in October, they issued a data call to insurance companies to divulge more information about how climate risk is affecting their ability to offer affordable and broadly available property insurance. And we won't see the results from that data call for probably about a year. But it's important to note that we have a fair amount of information about what this is looking like in state and local communities, because as climate risk grows, floods and wildfires are really disrupting the insurance market and therefore the housing market in a wide number of places. You're seeing large premium spikes. You're seeing insurers pull out of certain areas. Last year, AIG and Chubb, who are two of the major insurance companies that were insuring homes in Southern California, announced that they were pulling out of certain parts of Orange and Los Angeles County, which was a really big deal. The California Insurance Commissioner actually has the power to issue a moratorium for 1 year on cancellations and market withdrawals. The Department of Insurance, a staffer at the Department of Insurance in California told me that he was, when I was working for Chairwoman Waters, I spoke with him and I asked him if they were going to extend that moratorium in 2021 going into 2022. And he said, well, it's funny you should ask me that because actually the insurance commissioner doesn't have any power to do that on their own. The way that the law works is that the insurance commissioner just plugs in zip codes that were affected by a governor declared disaster over the last 12 months and applies the moratorium to those zip codes. And when I helped write the law as a legislative staffer, I never imagined that it would be a sizable part of the California insurance market. But the moratorium that we issued last year applied to 20% of California's housing market.
Wow.
So that should just give you an idea of how acute the problem is. It's really bad in states like Florida and Louisiana, where the property insurance market is essentially starting to dysfunction and melt down. But it's also bad in states that are facing growing wildfire risk, especially California, Colorado, Oregon, Washington, and of course, New Mexico. And this story that I have at the bottom here is from a Santa Fe, New Mexican article last July, which found that New Mexico ranks 5th in terms of states that are seeing their premiums go up. Premiums rose entirely due to wildfire risk by 13% across New Mexico last year, and in a state with, as impoverished as New Mexico, that is a really big deal. Actually, the insurance superintendent, Russell Toll, retired in January, and the interim insurance superintendent, I don't know, I'm brand new to New Mexico, so I don't know whether she's going to fill the role long term, but she came in and said that her number one priority is addressing how wildfire risk is affecting homeowners here in New Mexico. You're seeing a similar dichotomy to investment policy and pension fund policy in the insurance context. The National Association of Insurance Commissioners since 2011 has put out a voluntary climate risk disclosure survey, which 15 states, including New Mexico, participate in, but they're mostly, pretty much entirely Democratic appointed insurance commissioners who have opted into that climate risk disclosure survey. But until last year, this, sort of minimal, at least tell us the climate risk that you're exposed to, was as far as any state had gone in terms of climate insurance regulation. And then last year, New York and Connecticut, New York by regulatory guidance from New York Department of Financial Services, and Connecticut through state legislation, adopted guidance that requires insurance companies in those respective states to conduct scenario analysis, which is a commonly used tool in the bank regulatory context, on their balance sheets. So they have to now anticipate how their balance sheets would respond to different temperature and sea level rise scenarios. And this is expected to help at least even out the exposure that they have, particularly in vulnerable coastal communities. And I don't think it's a perfect solution because insurance policies are set annually. And so I think we're going to need to look at this issue much more holistically. But I do think that it is a step in the right direction, and it is the furthest that any state government has gone. I also failed to mention before, insurance policy is almost entirely set at the state level. To my great frustration, when I worked on the Financial Services Committee, there's broad federal preemption against insurance regulation. So it is an area of policy that's critically important to climate and critically important to financial stability, and yet is almost entirely up to state regulators and legislators to manage. On the flip side, you have Florida and Louisiana. They're basically framing insurance, the insurance disruption that their markets are experiencing as a consequence of frivolous lawsuits. And so in December, Ron DeSantis convened an emergency session of their legislature, and they passed a big insurance overhaul. And among other provisions, it required that Florida has a state-run reinsurance company called Citizens, which 1.3 million Florida homeowners participate in. And they're essentially trying to discourage participation in that. And so their solution was to pass a new requirement that if the private insurance market comes along and offers a policy to a Citizens policy holder that is within 20% of the annual premium that they pay, they are legally obligated to take that policy. So if you're paying $5,000 annually through Citizens and a private insurer comes along and offers you a $6,000 annual premium, Florida law now requires you to take that deal. Louisiana, their legislature doesn't convene until April, but it was recently reported that 12 Louisiana state representatives had a lengthy meeting with Ron DeSantis to discuss insurance reform. So this is another area where you're seeing a big divergence in terms of what Dem trifecta and Republican trifecta states are doing. But importantly, it's an area that is very ripe for reform, because as I mentioned, the scenario analysis idea is, I think, a really good policy, but not by any means a comprehensive or perfect solution. There's a whole lot of ideas that in this space that no state has yet adopted, and so there's a lot of potential. And I can share more information and details about some of those ideas, but I did want to mention one in particular is that the Connecticut, there's a bill, SB 1115, that is going to have a hearing on Thursday in Connecticut that now requires insurers, that would require insurers to essentially pay a surcharge for any fossil fuel underwriting or new infrastructure or projects that they developed. And I think that that is sort of the next frontier after scenario analysis. This is the very last slide. I will probably be very short here, since many of you on this call are much more involved in this than I am even, and Tom could probably speak at length to you about this. But another aspect of bipartisan infrastructure law implementation is that the IIJA that was passed in 2021 included $4.7 billion to help oil and gas production states plug abandoned or idle wells. It also included an incentive to enact financial assurance rules and strengthen surety bond requirements, which Colorado did last year. But we're finding that Colorado law, which was the strongest regulation in the country passed to date, still is inadequate to crack down on the real problem of fossil fuel companies unloading their regulatory liabilities onto the public when they go bankrupt. And that is both related to oil and gas remediation and cleanup, but also pension liabilities. So you all have already signed on to the New Mexico Oil and Gas Justice Act. I won't describe that to you since people far more knowledgeable than me have been working on that. But there is another proposal that I'm interested in, which revises state code governing fraudulent transfers, which is the mechanism through which fossil fuel companies are unloading their liabilities onto the public. And bankruptcy scholars, although they generally tend to emphasize that bankruptcy policy is largely set at the federal level, they have confirmed that if you did this at the state level, Delaware judges who handle 90% of corporate bankruptcies would defer to New Mexico's code with respect to fraudulent transfers. So bankruptcy reform is another area where, although I'm clear-eyed about the opposition we would run into, I think it's another promising area of climate financial reform at the state level. And that is all that I have. So I'm happy to take questions.
Great. Jordan, I just popped into the chat, the fact sheet that we have for the Oil and Gas Reform Act, SB 418. So if people want to read that, that's a link they can find. Sorry, Jim, go ahead.
Yeah, so Jordan, I just wanted to see if Steph is still on the call. I had a fascinating conversation with her a couple of months ago. She lives up in T. Harris, and she in a lovely house in the woods. And so the question was, what's happening with your fire insurance and what's happening with your neighbors? And just as a way to get at the discussion of the interlock between the insurance industry and the banking industry. Because if you don't have a fire insurance on your house, you don't have a mortgage. And so, Steph, are you still on?
Yes.
Oh, good.
Yeah.
Could you just, you remember that conversation we had? Just make it a little more concrete for us about what's it like to live in a part of the state where the insurance is going up tremendously and some people can't get it.
Well, yeah, I feel, and I'm sorry, I can't turn on my camera right now, but I feel very fortunate to get insurance because near where we live, there was the Dog's Head fire, and after that, a lot of the insurance companies wouldn't insure anybody here. And I have one neighbor who cut down, 36 trees around their house, which is what the insurance company had required. And then they still decided not to insure her. And she had to go through, I think, 5 before she could find someone who would. Our policy is really expensive and our deductible is $50,000. I put that in the chat. But I also put in the chat that I know a lot of the people in the Hermit's Peak Calf Canyon fire couldn't afford insurance, and so they lost everything. But you can also have people say that we shouldn't live next to a forest either. So there's that argument too. But I just feel very lucky that we could find someone to insure us at all. And we're lucky that we can afford to pay it. But I think our premium's $5,000 a year. So that's that.
Thank you.
Yeah, it's something that I think is, I'm interested in partnering, and I actually have heard from a friend who works at the Consumer Federation of America and is very active on insurance issues, that that he's been trying to meet with the new insurance and superintendent, and she seems friendly, but hasn't yet been, sort of transitioned into the new role, but would love to arrange a meeting with her. And it's probably not going to be that impressive for her to talk to me, but affected people like you, she should definitely be meeting with.
Jordan, this is Ann. How is it looking for SB 169? What's the word in terms of its viability and chance to get all the way through the legislature this session?
Is Beth Beloff still on? I saw she was joining at the beginning, but I don't think she's on anymore. Okay, well, Beth Beloff has been really the driving force behind that legislation, and so I was gonna have her answer, but my understanding is that that Senator Munoz is not opposed to the legislation, but wanted to have it a new draft, which was, as amended in the Senate Conservation Committee, provided to him before he discussed the meeting and scheduled this hearing for the next hearing. And I know that Beth shared with me the new text, and that has presumably happened at this point. But my understanding is basically that if it gets through this next barrier, which is the Senate Finance Committee, that it is very likely to ultimately pass. And as I mentioned, it got a Republican vote in the Conservation Committee. So the prospects are looking pretty good. I understand the governor's office has been supportive, but I also don't know how much she's prioritizing this. And I would just sort of say, Beth has data and fact sheets on the percentage of New Mexicans who are energy burdened, meaning they spend a considerable portion of their income on utility costs, and it's 15% in New Mexico. The national average is 2%. So I think this bill, although it requires a $20 million seed investment to create the Climate Investment Center, is going to be hugely in New Mexico's interest and is going to attract, I think, substantially more than $20 million as soon as this fall or early next year. And so it makes a lot of sense. Munoz from Gallup is the main person that people should be writing to, calling, getting in touch with. And then I would also say, if the governor isn't making this a priority and isn't going to be leaning on Munoz to schedule that hearing, she should be.
And is Beth with a certain organization that we could contact her so she keeps us updated?
Yes, the Beth's organization is called
Coalition of Sustainable Communities.
Yes.
Okay, thanks.
And I do have one thing to add on that and the governor's support. So the governor, I believe, is in fact quite supportive to the extent that she had her infrastructure czar, Marty Chavez, drive to Santa Fe and meet with Senator Munoz, the chair of the committee, last week to lobby in favor of passing it. So it's an indicator. I know because he called me.
Jordan,
So,
oh, Susan Homer has a question and then we have one in the chat.
okay, good.
Yeah, I'm wondering about HB 12, the hydrogen bill that may or may not come forward, I guess. And whether what your thoughts are about that, because that could be, well, I guess there's a lot of money for it, but it could end up really costing a lot in other ways.
I haven't been working directly on that bill. I did read the Capital and Maine story about a very good and sounds like a lot of groups were in support of a of fulfilling the governor's request from last year to create a climate change bureau and start to implement the just transition in New Mexico. It sounds like that is being hijacked a little bit, quite frankly, by this hydrogen hub effort. But beyond what was reported in that Capital and Maine story, I don't have any additional insider information, and probably others may know more than me. So go ahead if anyone has more thoughts to add.
I think, Jordan, that's a hijacking is a interesting topic. You know, in SB 169, it's an interesting piece of legislation. I haven't read it in detail, but I scanned it, and it seems like in the current climate, it could be subject to being hijacked too, because it has, you know, references to green this and green that, and we've had a problem in the past in this state where, you know, green energy, well, maybe there isn't a statutory definition of that. And maybe natural gas is green, you know, or might be someday, or maybe nuclear is green. So could you talk a little bit about what kind of fences are around the details in this bill?
Do you mean in 169?
Yeah.
Yeah. So SB 169 is has a list of explicitly eligible projects, and they're all you know, solar, wind, geothermal, it's targeted specifically to qualify for the investments that are specified as eligible for support through the federal greenhouse gas reduction fund. And so because it's aimed at that and has, you know, the sort of copious guardrails around only putting forward a climate investment plan that is going to meet those targets, there is it's thought that that there is not great potential for it to be hijacked. Additionally, all green banks, all of the existing green banks, and sort of the entire premise of the Greenhouse Gas Reduction Fund are to fill financing gaps, particularly tangible consumer facing ones like solar rooftop. And in the EPA program guidance that came out on February 14th, the EPA actually clarified that the $7 billion in direct grants to state and local governments are to be prioritized for solar rooftop and battery storage. And so that to me is an additional signal that something like nuclear, which is hugely cost intensive, but has a lot of private sector investors that are already willing to enter the market if the safety regulations or the permits are approved as well, or even hydrogen, which while really not totally viable in a lot of ways, like certainly has a lot of willing investors, is not going to be a part of something like the Climate Investment Center.
Thank you. I'm kind of paranoid, sorry.
It's totally understandable.
And then we can do a quick wrap up. Thank you.
Mario, go ahead.
Hi there. I was actually just wondering if you could go maybe into depth a little bit more about the green banks. I think I have an understanding, but I was just wondering, is the concept that we are financing or filling these financing gaps through investment in green companies?
Yes, it can be, although the term green bank is very broad. It encompasses everything from Connecticut's Green Bank, which is a quasi-public, mostly state-run agency that supports a wide range of investments, and it does issue bonds, and so therefore can be invested in startups and small businesses that are entirely involved in clean energy deployment and services, to a small nonprofit in St. Lucie County, Florida, called Self, which mostly exists just to help low-income community homeowners in St. Lucie County, Florida, install solar on their rooftops. And while that is a great program, I don't know if it should necessarily be included in the very broad definition of what constitutes a green bank. But so that's a kind of long-winded way of saying, in some cases, this can mean investments. In some cases, it can sort of look like venture capital, where you're supporting a clean energy company or helping get a clean energy company going. But in many cases, and particularly with respect to the EPA guidance, we're thinking that this is going to bridge financing gaps, in the sense that utilities and major financial institutions tend not to support particularly low and moderate income communities from making the kind of clean energy upgrades, decarbonization, and energy efficiency changes that they want to make to their homes, and are entirely cost effective in the long term, but because of short-termism in the financial sector, tend not to get prioritized by the financial sector.
Thank
And
you.
the fact sheet for the Green Bank bill, I just posted in the chat if you'd like to get the definitions.
Thank you.
We have Angela's got a question in the chat and her hand up.
Jordan, my question in the chat was, how do you see the potential of public banks in comparison to green banks, the latter of which are actually revolving funds and need ongoing appropriations, while the public bank can create, 8, 9, 10 times the amount of capital that the bank is holding, which would increase the amount that could be invested in projects. I wonder how you look at that.
Yeah, I totally agree. I really like public banks. I think in a perfect world, we'd be sort of moving these two issues together in tandem and setting up green bank structures with revolving loan funds and all the other attractive features that many green banks have, and structuring them as public banks. There unfortunately is language in the guidance around the greenhouse gas reduction fund that prohibits federal funds from going to depository institutions. I can't exactly explain why that is exactly, but I think it might be reasonable to surmise that the political opposition that the banking industry would bring to any kind of creation of a new green bank for the sake of competition, it was just deemed not worth not worth complicating the imperative of making this substantial investment. So that having been said, I'm talking to I talked today with some folks with the California Public Banking Alliance. There is some discussion about leveraging the new public banking law, which sort of promotes public bank experimentation by California municipalities, but also had a requirement that to do it, municipalities would have to partner with existing community development financial institutions, CDFIs, and a substantial portion of this greenhouse gas reduction fund is expected to flow through CDFIs, and the $20 billion tranche is expected to go through at least one, maybe multiple networks of CDFIs, like the Opportunity Finance Network. And so what I was discussing with the California Public Banking Alliance is maybe we can use this as a moment to get some seed capital for a non-depository institution, but use that as a partner to use that as a CDFI partner, and then leverage that into ultimately a public bank in Oakland or the East Bay or something like that. So I don't have a full comprehensive plan in place, but I do agree with you that the public and green bank conversations should converge wherever possible.
Thanks, Jordan. I'd like to talk with you further about that because our group, Alliance for Local Economic Prosperity, it has been advocating for a state public bank in New Mexico. And we think that the needs that we've identified establish a strong rationale for that. And it's only enhanced by what's happening now with the Green Bank. Thank you.
Yeah, I'd love to talk.
And Jordan's contact information is on his website, which is in the chat. Nancy, you want the last word?
Yeah. I just I want to thank you, Jordan. This was amazing, and in my comments I put that we'll have to have you back every year because we really do need this kinds of comments. But my question, I guess it's a question. We all know, everybody on this call is aware of the fact that the impacts of climate change, why we do this work, are enormous in every single aspect of all life on the planet. But you somebody said this was a really scary presentation, and I'm thinking what they meant was it's bad enough to have to address this stuff, but if we don't address this stuff in a way that is constructive and positive and helpful, whether it's in investments, in stranded assets, in insurance, in everything, I just sort of ... what this is not a good thing. This just accelerates and exacerbates the actual problems that we're having with climate change. So I just was wondering if you could comment on that at all.
Well, I hope I didn't depress you all too much. You know, I think that we, everyone on this call understands the the seriousness and the gravity of climate change. And I think that to take I take heart though in the insights that we get from our messaging and polling about how much people really want to have their elected officials shield them from climate chaos, and integrate their state's economy with the many benefits of a just transition. And so I think that there are really exciting things happening with respect to IRA implementation, environmental justice, and entirely new ways of thinking about financial regulation, law and political economy, antitrust. Like there's a lot of really exciting economic thinking happening right now. And the whole sort of thrust of the work that I did with Sale on the National Investment Authority and the Green Bank paper that came out of that is all about trying to facilitate climate and industrial policy and coordinating climate and industrial policy in a long-term way. But I will also say another thing. You kind of were talking about the very stark sort of civilizational collapse scenarios that are looking unfortunately plausible. And the Sheldon Whitehouse, who the senator from Rhode Island, who just he took over for Bernie as the chair of the Senate Budget Committee. He had a hearing last week on that went beyond these sort of financial regulatory implications of climate change and examined this question of whether the social cost of carbon has dramatically been understated and whether CBO, the Congressional Budget Office, and basic economic forecasters are vastly understating the impact that climate change is going to have just on GDP. Because we can talk about physical and transition risks, and we do, but like, what about like not being able to grow corn in Iowa at all anymore, and things like that. So I think the Fed is starting to move towards actually integrating climate into their macroeconomic and monetary policy projections, and that is a good first step toward exactly what you're talking about.
Jordan, I think that is a great place to jump off. A good thank you, Nancy, for that kind of the summation where we were tonight. Just from a personal point of view, my head's about to explode. You threw a lot at us, and I think Lucas, when you write your paper for school, that you share that with us so we have something that we can get a hold of. I also want to reiterate what Nancy said about how successful this discussion has been, and I hope that we can get you back on a much shorter time schedule than a year. Jordan, thank you so much, and good things happen when you hang out at the Roundhouse. I love it.